Good afternoon, everybody. Once again, this is Michael Burke. We're just waiting for Larry to get set up. He's in the room, so there he is. Hey, Larry. I'm going to get started. You want to? We'll do a quick sound check. Hey, Larry, you sound great. So I'm going to get started, and we'll turn it over to you in just a minute. So welcome, everybody, to the second installment of our technical analysis series with Larry Williams. My name's Michael Burke, and I'll be just kind of hosting for a couple minutes here before I turn it over to Larry. This is the second part of a three-part series that Larry is doing, and if you missed the first part, that was a great primer in technical analysis from the Larry Williams point of view. So if you missed, put the link for that in the chat right now. So there's the link to that. You can save that link and look at that a little bit later. The next event is coming up on August 22nd. That'll be the last part of this, and you can sign up for that here or on the webinar calendar. Either of those will allow you to register for that event. This is the link for that event. This series is has been well attended, and we've got customers and friends of Tradestation from all over the world tuning into these events. So wherever you are in the world, welcome. And we have another great presentation for you. And Larry has been a longtime friend of Tradestation. He worked with the original owners of the company, the original founders of the company, and so Larry's always been part of our family, and just an overall great educator in technical analysis and trading the markets. And he brings a very unique and experienced perspective to technical analysis, and we're very, very happy to have him for this series. The following presentation is for educational purposes only. All of the ideas discussed are for educational and demonstration only and not recommendations. Active trading is not suitable for everyone. Please read the disclosures in the document that I'm pushing into the chat, or take a look at the disclosures on the homepage of Tradestation.com. So as I said, we have a number of great events coming up with Larry. If you take a look at the schedule here, Larry also has an event on August 28th where he'll be showcasing some of the products that he offers on Strategy Network. So that's a new event that we've just added to the calendar. So take a look at that event as well. You can register for that event here. I will put that link into the chat. There you go. And so we have a number of Spotlight On events with Hema Reddy and Eli Finucci. All of those are great events for learning more about the markets, learning more about technical analysis. So there's always lots of events going on at Tradestation in addition to our morning market commentary and futures events and forex events. So there's something really for everybody. So keep an eye on the calendar. There's always going to be something that that may interest you. Also, if you miss an event, no worries. We always archive every event, and you can always go to our website and view any event within a couple of days of the day that it aired, and watch that event and download any materials that were provided with that event. So without any further ado, let's turn it over to Larry for part 2 of our technical analysis series. Larry, it's all yours.
Well, thank you, Mike. It's always an honor to be here. I wonder sometimes why I'm able to do this and just have people follow what I do. I've just kind of been trading for quite a while, and it always amazes me that people are interested in what I'm doing. The last time that we met, we talked about basically the history of technical analysis and what these things can do. It wasn't a real practical application, but I really believe in history, and I believe we need to know and understand our indicators and our past if we're going to succeed at things. So this time we're going to put it into practice. And the things we talked about last time, I'm going to show you how I actually use those in my own trading. And then in the third, in this section, if you will, in technical analysis, I'm going to show you what I think are some of the newer ideas that are going on right now, and some new approaches and some more advanced of my work. So with that, let's begin. As always, of course, if you have questions at any time, feel free to just pop in with a question. I cannot answer questions about current markets. simply because I'm locked into the power points that I have here in the presentations. When I can't go to a chart, I can tell you if I can remember about the market, but let's try to keep it about what I'm talking about today. But if there's something that's just you're dying to know, feel free, of course, to ask them. So let's go. And now I've got to figure out how to advance the slide. Oh, here we go. Remember that. So here's the parts of technical analysis that I think are important. You can use cycles in technical analysis. I'm going to try to see if we can't bring up a little drawer here. Right. We can use cycles in technical analysis. We can use market structure, which I'm going to talk about today. We can use trend analysis. And that, of course, is what most people are focused on. And I think there's certainly is a place for trend analysis, but I'm not certain that that's the be-all, end-all of technical analysis. And then there are indicators, and there's been a plethora of indicators in the marketplace. I've really narrowed down the indicators I use to accumulation distribution indicators, similar to on-balance volume. Sentiment, I want to know what the wisest money in the market is doing and the dumbest money. And that would include the COT report and my synthetic COT report for stocks. And a really big one to me, to my way of thinking, is momentum. So those are the basic tools that I use. And now I get this closed down. I guess I don't do that. Move it out of the way. So I'm going to talk first about cycles. We talked last time about finding the dominant cycle for your time frame, and people just get into all their cycles in the markets and history and everything else, and there is, but you have to find a cycle that fits your time frame. If you're a day trader, you're not interested in a 4-year cycle at all. You're interested in an X number of hours of cycle, or maybe something I'm going to show you today. If you're a long-term trader, you're not interested in a 15-hour cycle. You're really interested in a 2-year cycle or a 4-year cycle or whatever. So just because you found a cycle out there, you have to make certain it fits your trading style and the time frame you like. There, I think, is a universal cycle, and I'm going to try to demonstrate that to you today, that I think is applicable to stocks and commodities, regardless of the time frame, short-term time frame or longer-term time frame. And then there are long-term cycles, and I'll give you some of my comments on a longer-term perspective of the market and longer-term cycles in the marketplace. So we'll be talking about those things today. The red line that you see is what I would call a universal cycle. By that, I mean the formula you're going to be seeing on the next 5 or 6 charts is the exact same formula, irrespective of the time frame. We're looking at a 5-minute time frame in S&P E-minis. Now, this red line is known in advance, quite a bit in advance, in fact. So generally, the cycles are telling us we should experience a low down in here, a market high here, a rally should start here. That's a real quick rally. That's pretty much what happened. Then a pullback and a rally, a pullback into this zone, a rally, and then another rally, quick flashy rally right here. This projection was known prior to this happening. This is not comprised of any of this data, as you'll see in a moment. Here's the red line. I think this is a continuation of this red line. Yeah, here's this little rally, and there is a projection in advance of the market should have some type of a rally here, and then it should come down as it did and start to rally and then pop up again here and then slide off. So we can get an idea in advance from cyclical tools of what should be taking place in the marketplace, and that's a real advantage. It isn't something I would trade by itself, but as a short-term day trader, I'm certainly interested in buy signals here and sell signals here and a buy signal in here because I see that the cyclical strength should be to the upside. It's not always perfect. Sometimes it's a little early, but by and large, it gives us a really good idea of what should be taking place in the market. Now, the same formula here is applied to Apple, but on a daily basis. So this point was known about 3 months in advance that Apple should top out here, just as this rally down here was known about 3 months in advance. And the nice thing is that it's giving us warning that there should be a rally here. But the problem is we don't know how long, we don't know how high the rally will go. We know the rally should last till about here. We should have a pullback from this time period to this time period. But the magnitude of the move is something that cycles don't predict for us. They just tell us a move should start. But gosh, is that valuable? Well, certainly in the land of the one-eyed and the blind, the one-eyed man is king, right? That to know that Now my buy signal should be more effective than just any buy signal. That's the advantage of cycles. To get the magnitude of the move, we're going to have to turn our attention to some other indicators that I'll be talking about. Now, what interests me is this formula for the Apple projection here is made the exact same way as the 5-minute chart that you just saw a moment ago. It's the exact same calculations, the same everything. So that to me tends to be what I think is a universal cycle. Here's another example of Apple. And the point is that Bentley is making here is, so sure, we have sell signals up here, and we want to be taking sells in the cycle work. We can see that. But the question is the magnitude of the move and managing the trade. This is not a get in and do this or do that. It's a, we're looking for sells here, buys here, sells over here for a move down to this area. That's the advantage that we get from using cyclical stuff in the marketplace. And it can be a huge advantage for us to know in advance there should be a sell-off of some time, which would include magnitude. What is the actual signal? Well, Peter, just hold on a little bit, and I'm going to show you some entry techniques. We're first talking about setup tools. I think everybody wants entry techniques, but they don't have any perspective of how these fit. Now we're looking at Annaly Mortgage. I bought 10s and 20s and 30s and 40,000 shares of this stock down here because my cycle just recently, because my cycle work was saying we're coming into a low. I had been long the stock up here and sold about 100,000 shares of it up here because I saw this should happen. No guarantee it's going to happen, but I exited my Annaly Mortgage in here and bought it back here. And I liked the stock. It was yielding 14, 15% when I bought it. And so it may have some downside, but 14%, 15%, it's quite a bit higher than my bank base. So that's the advantage of the cycles. It alerts me to a time period when I really better be careful of my long position. I bought long in here because of the rally coming. And then here I see, oh gosh, what's ahead? And that was time to exit and look for an entry point, which I did down here. So that's an actual trade I actually have done with a substantial position in the stock. It's an alert, it's a warning to me, and then I can come into the shorter term basis to look for an actual signal. Here's gold. You can see the sell-off in gold that we had, and clearly we had a pretty good indication that from about this point on, gold should decline. And now gold has started to rally. Well, look what the cyclical forecast is telling us, that it should rally. So that's the advantage of it. Back here, I bought a lot of gold, and I took maybe $50,000 out of the market on this move. In part, I bought because I knew that we had a cyclical low coming into this market, and we should rally somewhere between here and here when this rally started to drift apart in terms of cycles. So that's how I use cycles, to be as an alert. And it can be used on any time frame. Here's gold on a 30-minute time frame. The projections, we should rally here, we should come down, start a rally, and drift off down again. So the advantage is it gives me a pre-warning, an advance warning of when I should see rallies and declines in the marketplace. But it doesn't tell me exactly how big it will move, the move will be, but it does tell me the duration of the move. So we see there's a high in the cycle here, but then we start to rally over here. So we know we have a potential selling area from here to about here. We can block that off as a selling area, a rally area from here to about over here. So that's the advantage of it. And it's obviously not the holy grail. There's no holy grails in the marketplace. Trading the market, if you think there's a holy grail or an easy way to make money, turn off your computer, turn me off. I don't think there is any in any way whatsoever. It's very difficult to trade. It's very frustrating to be a trader. But the combination of ingredients, I think, can make us better traders, which means we have less frustration. And that makes it easier for us as traders to take action when we have a whole bunch of things that are congruent, that we should have a market rally. Here's the bonds. Here's the forecast for bonds for my natural cycle. It's just cyclical work of the market. They should rally here. They should come down, have a bounce, and come down again. I see a couple of questions have come in. The cycle forecast makes sense. Is it in Tradestation? Yes, the cycle is in Tradestation. It's I think called cycle forecast, and it is in Tradestation. There's another way of looking at these turns in the market when they should take place I'd like to share with you, And that's my trading day of the month. This is something I pioneered 15, 20 years ago, where I have found that certain trading days of certain months have a great propensity to rally or decline. We're looking at July right now, and the July data for the S&P E-mini shows that the 7th trading day of the month has been the most profitable. It made $4,900 if you'd bought on the 7th trading day of the month and got out with the first profitable opening and with $1 stop. So I know there's a bias in the market around trading day 7, and then look at trading day 19, 20, 21. Gee, they're all profitable in there. So the last few trading days of July, but not the last one because that has not been profitable. But we typically get a little rally in here right around the latter part of July. So that's a unique point. If I am a very short-term trader or even a day trader, I know the worst day of the month for July has been trading day 13. Look at trading day 13 and trading day 14. My gosh, I lost $14,000 and almost $7,000 had you bought on those days. So it gives me an advanced look ahead of time, 1 month ahead of time of when to start expecting during that month when I should be looking for buys and selling points in the marketplace. So it gives me an advantage in that I'm set up. It doesn't mean the market will rally for sure in this day, but the probabilities are great in my favor. And then, of course, I can turn to a shorter term to see what's actually happening as those days unveil to get in or out of my trades. So the trading day of the month concept is just a great concept I've used for a long, long, long time. And I think you'll find it quite successful. What is the basis for the cycle forecast? Which data does it rely on is a question. Stefan, it's using whatever data we put it on. If we're using it on a 15-minute bar chart or a daily bar chart, you can put it on anything. It doesn't matter what your data source is. Frankly, I don't think it works all that well on weekly or longer-term time frames. I think it works much better on daily and intraday time frames. Is this based on an average of the SPY levels over the years? For those of you in Australia, the SPY is what some people call our S&P index here. In Australia, they also call their market the SPY. You probably know that, just so we don't get confused here. So how do we get so many questions coming in here? So this is based on looking over the last, in this case, we looked at the last 15 years. And in the last 15 years of the E-mini contract, trading day 7 was the strongest trading day. The great propensity, though, as you can see, is at the end of the month. There's a real cluster of bullishness that historically has happened at the end of the month. How do we get trading day of the month? I do this every month on my Larry TV program. Once a week, I talk about the markets, and we show at the beginning of each month for bonds, gold, and the E-minis what the strongest trading days of the months are. So that's another way of getting set up. This is what we saw in the cycle and what we saw in the seasonals. Is what we're trying to find an advance warning. Say, hey, I want to wake up and be in the markets at this time. Maybe even have a cup of coffee, get prepared for it. Now, that July trading day 7 in the last 15 years, this is the equity curve of what's taken place. So you can look at the equity curve in Tradestation, which is really great. There's a lot of tools in Tradestation to help you look at the performance of your system. The simplest one is to just look at the equity curve. And I like that to see, well, is it consistent or is it erratic? Well, it had one really losing trade here and rest of them been pretty successful. So yeah, it looks like that's a trading day of the month 7. I want to be alert and aware as a short-term trader for a buy signal at that time of the month in July. August is an interesting trading day of month 7 for gold. Going back the last 12 years, there's the equity figure for that. I thought you'd enjoy that. That gold typically has rallied around to what trading day 7. And that is obviously an alert that around trading day 7 of the month, you want to be looking for a buy signal in gold, and go back and look at gold and see what happened trading day 7 this year. This does not include data from 2013, only through 2012. And so you have to count the trading days in the month. Though we have a little thing we're going to introduce in Tradestation that will tell you what trading day of the month you're in. We have it developed, and it's kind of a cool little tool. So you know where you are in the month in terms of trading days. So again, just trying to find, and here's the seasonal trading day of the month for gold in August. And you can see which trading days of the month have been the best. Trading day, look at the end of the month, 19, 20, 21, 22. Wow, a lot of green lines in there, huh? With some pretty big profits in there. So we know the end of the month in gold has been bullish. Trading day 8 and 9 have not been bullish, have they? And there's a cluster around trading day 15, 16, 17 right in here about where we've been seeing the rallies in the marketplace. So that's one of the tools that I use to help me get into a trade. I don't want to just take a trade just because the market's trading. Maybe it's because I'm 71 years old now, and I don't want to trade just for the fun of trading. There's only one reason to trade is to attempt to make some money at this. It doesn't always happen that way. But I want to have as much stuff going for me. I want the scales loaded over balance in my favor. So another tool that we can use is a seasonal forecast in the marketplace. And I'm showing that now. It looks like a couple of questions have come in that I missed here. Let me read the questions for a moment. No, nothing. I don't think anything of great consequence. Okay, so the seasonal, people know a lot about seasonals, but when I started trading, there was no such thing as seasonals. We did not have seasonal indicators. In 1973, I wrote a book about how seasonal factors influence commodity prices, and that started with literally the springboard for every seasonal work you see now. I've actually altered my viewpoint a little bit that how I can create the seasonal index is different now than virtually the way anybody else is doing it. So this is a seasonal forecast for the E-minis as an example. The E-minis, though they've made a little bit of a new high in here, they haven't in the advanced decline line, typically are under seasonal weakness at this point. And those of you who are really into seasonal trading or you like this as a tool, I really suggest you look at one of the other videos I did on seasonal trading, because that's really the secret to seasonals in there. I forget which one it is, but go look at them and you'll be able to see that. Joe, is that comment addressed to me about nothing of consequence on an indicator? If so, tell me again and I'll try to be more specific for you. Will you follow up with Sydney about trading day of the month? Well, I've got so many questions here. Where is TDOM in Tradestation? It's not in Tradestation yet. This is something that's just private in my work. We hope to offer it in Tradestation, but I don't have it in Tradestation at this point. Okay, I guess that answers your question. So I also look at seasonals to tell me that I should have, this is wheat, that typically wheat starts to rally in here, starts to sell off in here. And wheat is, seasonal is nothing that's mandatory. I take the trade. Again, I would suggest you look at the seasonal study I did for Tradestation, but it's suggestive. Like, oh, we usually rally here, so I want to be aware of those seasonal rallies, because what I found is typically the markets rally in here, as we saw in cotton. Typically the markets start to come down. So it gives us an advantage, if you will, in the marketplace that sets us up for a trade. It is not an entry. It's not a reason to go out and buy or sell, but oh, we're getting into a selling point, a rally. We start a nice rally in here. That's the advantage of seasonals. Okay, so the next thing I want to talk about is market structure, because now we're getting into more of those entry techniques that you guys and gals were asking about. This is a huge, huge thing in my work, just massively important in my work, and it's what I call market structure. And market structure looks like this. It's a blue line that basically connects all the highs and lows in the marketplace. And notice as we're coming down, we don't get any higher blue lines until here, and then we get a rally. Then we get a lower turn down in the blue line, and we get declines, and we don't get any higher blue line peaks until all the way down here when we have a short-term low higher than that short-term low. So when I'm looking for an entry in the marketplace, let's go back a chart here. We'll go back to that wheat that was in such a big downtrend. Wow, it's coming down, coming down. Well, I don't want to be a buyer in this market, even though I have seasonal strength, until I'm making a short-term low that's higher than the prior short-term low, which that one isn't. That one is. I have a potential for trade. This one isn't. So market structure shows me when the market has bottomed and has started to base. Here, notice I have a short-term low higher than that one. I can be a buyer. Market's had a big sell-off. I have a short-term low higher than that one. I can look to be a buyer. I clearly look to be a seller here and here, because I have short-term lows that are lower than the prior short-term lows. That's the advantage to market structure. So that's how I will look for an entry in the marketplace. Here's this was gold last year that I had a really good look at the marketplace. I start making higher short-term lows. So once I know I have a short-term low in here, I can be a buyer in the marketplace. And the nice thing is it keeps me on the right side of the market. It keeps me away from being a buyer in a big downtrend. In other words, the market has got to stop, come up, pull back, and not make a new low before I'm even interested in buying. And that is really, really helpful so we don't get in too early. What indicator is the blue line? It's a custom. It's a standard indicator. I think it's called zigzag in Tradestation. Now we're developing something that's maybe comparable to this. We haven't done it all yet, but okay. So here's a great question: how do you find short-term low high pivot points? You can do it in a couple of ways. The easy way is to just have that the move must be X percentage or more. So you're only going to catch swings like Art Merrill did years ago of just a certain percentage point. This is not wave theory. Notice wave theory says there's 3 waves, 5 waves, 18 waves, Fibonacci waves, whatever. I don't count waves. I don't know anything about that. It's just too complex for me. I'm just looking for to see the formation low or lower short-term high. But basically, to answer Donald's question, Donald, that's my ring high, ring low concept. Yes, Bentley. So basically what I'm looking for is a high that has lower highs on both sides of it. That's a short-term high in the marketplace. A higher short-term low would be a day who I look at a day, and that day has a higher high and a higher high the prior day. So the markets come down and come back up. So I know that's a short-term low. A short-term low will have higher lows and higher highs on both sides of it. So I can mechanically define these short-term swings in the marketplace. Here's another example of market structure. Yeah, Doug, I agree with you. There's exceptions and rules, and I'm a pretty simple guy. I'm looking for lower short-term highs in the marketplace, higher short-term lows to be a buyer if the market's set up. So that's why when the cycles are saying, well, we've got a turning point in the market here, maybe commitment traders has a turning point in the market, then I can take action on the formation of the higher short-term lows. I would not want to do that, however, unless I had the qualifiers we talked about there earlier. Question: you could have a rule to quantify the swings above and below. Yeah, you can do that, Ronald. I haven't done that. Interesting idea. Yeah, and most of this is explained in my last book, Long-Term Secrets of Short-Term Trading. Trend. Well, now let's talk about trend. Am I going to refer to premium carrying charge markets? Stefan, I hadn't planned that. We talked about that last time, but let me just step aside here because you commodity traders, you have seen history being made in the last month and a half, and I don't think any of you have seen it at all. Let me talk about that. Not in the PowerPoints, but it's really incredibly important. Go look at July soybeans versus the next month out. Look at September versus November. We have been in a premium market. In other words, the nearby contracts have been selling for more than the distance. And you look at how incredibly strong the July was up until the day it went off the board. It way outperformed, substantially outperformed the distant contracts. And that is part of the secrets of commodity trading. You want to be in the nearby contract, especially if there's a premium, because the premium means the commercials want the market desperately. They want it so badly, they'll bid up, they'll pay a premium for it. So the premiums are an incredibly important thing in the natural resource markets to follow. So make certain you go take a look at the bean contract here and the meal contract as well. Just a huge difference. Okay, so trend. Well, typically trend is measured with moving averages, volatility stops, and trend lines. So I'd like to show you, they've not all crashed together, Stefan. Go look at the difference between the different contracts. You're going to get a big wake-up call here. So here's moving averages. I like a 50-day moving average. I've been using that since 1963 or 4 or something like that. I don't even know what this moving average is. There's no magic to any moving average. I don't think one is any better than the other because the problem is, look, you're above the average, you're below the average, you're above it, you're below it, you're above it, below it. You can get whipsaw quite a bit with moving averages. especially if the market's in a big choppy trading range like this. My gosh, you're below it, you're above it, you're below it, you're above it, below, above, above. So obviously you just can't buy at the penetration of a moving average. Years and years and years ago, there was a study done by Merrill Lynch on the best moving average crossovers to use for virtually every market. The study was done maybe 1968, something like that, 66, 67. By then, we had the ability to replicate some of that stuff ourselves by hand or with punch cards, and we did, and we duplicated the Merrill Lynch study, and none of the best moving average crossovers held up in the future for any of the markets in the Merrill Lynch study. The temptation was to say, oh, this is the moving averages that are best for, say, cattle. Let's use them. Had you used the best ones that Merrill Lynch came up with, you would have lost your shirt in virtually every single market. So moving averages are a tool at best as I see them. Now you can combine two moving averages. You could have a crossover here and you don't cross until back over here. So there's your buy, but then your sell is down here. It can still get pretty whippy. So is there a way around that? Yes, there is. Wells Wilder, primarily Gresham Northcott years ago, came up with something called a volatility stop. Chuck LeBeau also wrote about it, calling it a chandelier stop. I use it, call it my will trend. And notice the difference. This is the blue line that's kind of stair steps down versus the moving average. The volatility stop, depending on whichever one you use, kind of hovers above the market and adjusts to the volatility of the market, whereas the moving average can be crossed above, below, back to the upside. But the volatility stops don't do that. They tend to hold the trends much better. So if you're looking for a good tool to hold into the long-term trends, I'd suggest my will trend or the volatility stop that Wells came up with. I think I've improved upon it a little bit simply because I've had more time to play with it than when Wells first wrote about it in his book. The volatility stop is in Tradestation, and in our tools, we also have my will trend stop in there. Here's another example. Volatility stops can get whipped as well. I mean, there's nothing that's perfect in this market, as I talked about. They just get beat up less. You look at the crosses above and below in the moving averages, they're all over the place, but the volatility stop will tend to hold and ride a great big move. If you think you're in a big runaway move, this is the July soybeans, the July soybean meal. You can see the incredible strength we saw in the July meal. We did not see that in any of the other delivery months of soybean meal. So it will sit back and hold, but not so far. If you got stopped out, if meal fell out of bed, look how far away your stop is if you're using a moving average. It's usually just too far away. Jake Bernstein has done some interesting stuff with moving averages where he wants a 1 bar above a moving average. I've done some stuff as well. I use a technique with moving averages, but you can't, and it works, but you can't use just a moving average alone. You have to add some stuff on top to moving averages. Well, the volatility stop can work on intraday as well. So if we know we're getting bullish in this area because we have a cycle forecast coming in, we see a seasonal coming in, then you can take your seasonal or your trading above the will trend stop or volatility stop. But unless we have, I wouldn't trade just volatility. I wouldn't just sell here, buy here, sell here. That's not going to make money for you. In Tradestation, just look for a volatility stop. For will trend, aren't you supposed to have a market in a 10 to 15-day move? Well, will trend will work on any time frame of the marketplace. It's just an indicator that says the trend is up. That's all of these are. Mine, everybody else, just says the trend is up. It is dumb. It is stupid. It does not tell you how long the trend's going to be up for. That's why we still have to have trailing stops and some other things going in the marketplace. But you're going, hey, the market's really set up to be a buyer. When do I buy? When do I get in? Oh, I got to sell here if you're set up for a sell because it's below the stop, isn't it? So as somebody was saying earlier, well, where do you get in? Where do you get in? Bentley, where's the new book you referred to? You can buy it on Amazon.com as the cheapest place. That's where I buy mine when I give them away for Christmas gifts. So that's the advantage of it. It says not only get in, but maybe I can be a buyer on a pullback as well. So if I'm above the volatility stop, I want to look to be a buyer on short-term weakness. If I'm below the volatility stop and see a rally, obviously as a short-term trader, I'd want to be a seller in here because I know the trend is down and my stop's not too far away. Trend line. I love trend lines. This is the big secret to the market because nobody uses them, I think. In the old days, we used them because we had paper charts and we just had rulers and we drew straight lines, in our charts. And so I love trend lines. I think trend lines are a great way to get into the market and into positions. Tom DeMarco has done a lot of work about this. You can read any of Tom's writings. Tom came up with an idea he called qualified trend line entries. And I've added a little bit to Tom's work. It's hard to add anything to Tom's work, but I've added a couple of rules of my own to trend line. The problem with trend lines is frequently you get up to a trend line and immediately the market fails. So Tom's developed and I've developed some rules say, no, we're not going to take this trend line entry, but we'll take this trend line entry. This is a clear trend line. So let's talk a little bit about how you draw trend lines, okay? What you want to do, we'll take this first trend line to the upside here. I want to get 2 points where one is higher than the last one. I can draw a trend line. Now it happens to be I get another short-term low higher than that short-term low, so I can continue drawing my trend line. So we have a trend line entry at this point. Here we have the 2 most recent short-term highs are here and here, and we can come on down all the way to here. Now as the market breaks to this new low, so we got our 2 most recent short-term highs. We have a short-term high here, and we have to go all the way back to there to get the 2 most recent that are down from each other. This is below that one. So there's our trend line coming in. And trend lines, to me, are just great because the market has changed trend at this point. We don't know for sure if it will hold the trend, but because we're using a combination of things here, we're saying we're going to have this year, we have to have this year, we have to have this year, then that trend line entry is probably going to be a whole lot better than just any trend line entry. Markets move for reasons. They move for conditions. So I'm a conditional trader more than a technical trader. I want to find the condition in the marketplace that's bullish. Then turn to the technical stuff to say, oh, okay, now I can be a buyer. And then you could almost throw a dart or use trend lines or volatility stop or a lot of the things that you people have. One thing I do like to use are price patterns. So let me talk about price patterns for a moment here. I'm going to take a sip of water if you don't mind. The blue little arrows that you see here are all entry signals based on a particular price pattern. I'm going to show you these price patterns and teach them to you today. Notice that they only appear when price is above the volatility stop. And in here we didn't get any. If they're below the volatility stop, they may not be quite as good, or they may. But this is a unique price pattern that tells me I want to be a buyer the next day at this bar's high. So here's a day you can see right here. So if I get above this bar's high, I want to be a buyer the next day. If I get above this bar's high, I want to be a buyer the next day. Over here, we didn't get above that bar's high the next day, and so there's no entry technique. That will happen. Not always, but it will happen. Here's another example of it. We've got to get above this bar's high for our entry technique. If we don't get above that bar's high, we don't have an entry technique. And if we do, and the market immediately capitulates on us, we're going to be stopped out at the prior day's low. So here's the price pattern. This is in Tradestation language for you. I'll leave it here for a moment while I explain it. I want a condition. I want today's low less than yesterday's low. I want an inside bar 1 day ago. And I want today's range greater than the range 1 day ago. And I want my world famous %R using just a 2-day %R greater than 70. If that condition occurs, then I'm going to have those price patterns on the chart. This is not the Tommy gun. The Tommy gun is another little price pattern that I use. I have several price patterns like this that I've created over the years. This is just one of them. Now here's the Tommy gun. I've blown, not Tommy gun, this price pattern. I've blown up a little bit. So here's the day. Notice we have an inside bar the day before. There's an inside bar the day before that red dot. The red dot says now if I get above this bar's high, I'm going to be a buyer right there. If I get above this bar's high, I'm going to be a buyer. If I get above this bar's high, I'm going to be a buyer. This bar, we didn't get above that bar's high the next day, so there's no entry in the marketplace. So that's a very effective little price pattern under a very short-term trader that you can take advantage of. Again, you can do it on its own pretty good, but you know me, I'm a conditional trader. I prefer to have some type of condition established in the marketplace. So the other technique that I like to use is on-balance volume, or my form of on-balance volume. I've developed several of these over the year. What I'm really looking for is divergence in the marketplace. This is soybean meal. Notice that price was lower here than here, but the blue line, my measure, this is on balanced volume, was higher here than here. It's the old Joe Granville on balanced volume. Joe's not doing real well these days. I hope he pulls through here and gets better. But there's a lot of divergence, so that sets up a buy in the marketplace. There's more accumulation than there is price weakness. A market peak is the opposite here. Price has made a higher high, but look at the peaks in on balanced volume are lower. So that's on balanced volume. It's a great tool on its own. I think we can probably make it a little bit better. I've combined price, open interest, and volume all into one tool. The disadvantage, we don't have open interest for stocks, so we're going to have to do something else for stocks. But you can see how this works. This is the bond market. Notice we have a lower low here than here. Wow, look at the divergence taking place. A lot of accumulation came in this market. And up here, when bonds are screaming, making a new high close, it looks so bullish, right? But look at the distribution that's gone on in this market. It's no wonder the market falls out of bed. And down here, we have divergence again in the marketplace and bonds rally. So I will use this, and what I like to do is say, oh, I've got my pattern in here of accumulation in the marketplace. Then I can go to just look for that little pattern I showed you, or a qualified trend line breakout, or whatever your entry technique is, because I've seen accumulation coming in the marketplace. Any technical buy signal that comes in here should be effective. Now, this is on balance volume in blue. This is a stock. This is Google. And then my green line is my measure of insider activity in the market, how I think they accumulate and distribute stocks. And you can see there's quite a bit difference. Notice as Google rallied up here, pulled back, rallied to a new high. On balance volume didn't show any divergence. But look at my insider accumulation. Clearly, this peak is higher than this peak. We're looking for divergence in the market, and obviously there. At the low down here, I had good divergence. The market made a new low here, lower there than there. So did on balance volume. My insider accumulation picked that up as a bullish opportunity in the market. And down here, price is lower here than here. My green line, insider accumulation, is a lot higher here than here, and that kicked off the rally. Yeah, I believe there will be a replay, Zachary. So I'm looking for the divergence in my measures of accumulation, and I think that my accumulation technique is better than OBV. Here we're looking at Apple. Notice Apple had a big run up here, but look at the distribution. Look how that green line just coming down here. These insiders are distributing the stock all through here. On balance volume peaked at the same time as price. There was no divergence. You know, the trouble with developing these indicators, I got to tell you, they're like your children. I've lived with these forever. So you tend to think that your children are better than the neighbor's kids, right? And same thing is true of indicators. The green line is not POVI, because POIV, price open interest volume, we don't have open interest for stocks. So for stocks, I have my insider, Williams Insider Accumulation Index, we call it. And you can see, just look at the huge accumulation. Well, the market's in a big trading range here. Look at the accumulation that comes in here while price is just holding there. Or when price goes lower here, big accumulation in the marketplace. Or at this peak up here, we didn't make a new high in accumulation, and price did. Question, don't insiders sell for all sorts of reasons? Isn't insider buying more reliable because insiders only buy if they think that's going up? Well, maybe I need to change the indicator's name. Yes, insiders, people who are inside the company, may only buy if they think the stock's going to go up. Their selling isn't quite as reliable. But I'm talking about, I guess I should call this inside traders. These are professional traders that I'm measuring with this green line. It's not insiders, not corporate insiders, because they don't trade on a daily basis. So I hope that answers your question, Sydney, and if it doesn't, just please let me know, okay? I'm not measuring corporation insiders. I'm measuring guys who are in the know about what's going on in the marketplace. I also look at advisory sentiment. This is an index we have in Tradestation that measures the number of advisors that are bullish or bearish on a particular stock or commodity. This happens to be IBM. When it's very high, about 90% of them are bullish on IBM, and look what happened to IBM. At this point, about 15% were bullish on IBM, 85% were bearish, and IBM rallies. And I have found this to be traditionally true for a long time period. The original idea came from Jim Sibbett at Market Vein to put these advisors to the test, find out when they're bullish or bearish, and then plot that against price to see what happens. And you can see what happens is when the advisors get really bullish on a market, we tend to sell off. Not always, of course. Instead, there's no holy grail. Here's Google. Look how very wildly bullish people were here, and nobody wanted you. Nobody was sending out emails saying go buy Google, and that's when you wanted to. Then they got very bullish on Google up here, and Google came down, and you wanted to be a buyer of Google. And I have just seen this time and time and time and time and time again. I first developed this indicator for Bloomberg in 1999. We've been public with it since 2000, and it's just held up so incredibly well over that time period. Now I can start to combine all these in terms of the future market and do what I call my trade setup. Now, I've shown this to you guys and gals before, so I won't spend a lot of time on it, but the red line that you see here is my commitment to trader index. That's a COT index. And when it's up here, the commercials are very bullish in the market. When it's down here, they're very bearish. That's well and good, but I want to put them on the opposite side of the advisors. If the advisors are very bearish, as they were here, and the commercials are bullish, then I'm looking for buy signals. When the advisors are very bearish, they're so bullish that they're bearish, and the commercials are bearish, then I'm looking for sell signals in the marketplace. So the advisors get bullish here, the commercials are bearish here, I'm certainly looking for sell signals. Our indicators free at Tradestation, need to buy them. Is the sentiment index available? We actually have a couple of packages of indicators in Tradestation. We're going to change that. So get our free ones for now. There's quite a few free indicators you can get. A lot of the tools I've shown you today. But coming up in August, we're going to just go to 2 packs. And they're not going to be very expensive at all. They're going to have a really blowout low price on them. So get the free ones for now. And then we're going to have them, but there'll be a monthly fee, but it's not going to be very high. I mean, I've got to have a programmer that does all this stuff. Tradestation doesn't support my indicators, so if you have a problem with the indicator, it doesn't work. You don't go to Tradestation, you go to us. We have to do all of this stuff for you, so we can't give it away for free. Actually, I'm in Colorado right now with my programmer, getting ready for all this stuff, but there's a lot of expenses to it. But the price is going to be really low for you, like 10, 15 bucks a month. Okay, so here's another setup in the marketplace. Now I see I have my seasonal tendency I've added here to soybeans. Oh, I see soybeans typically rally this time of year on a seasonal basis. And then I see that the commercials are real heavily to the long side up here. And the advisors are really bearish down here. Now the upper chart, the blue line shows the large traders position in the marketplace. The green line shows the small traders position, and the red line the commercials. You see the commercial were accumulating gold all during this time period, or soybean, and then the market took off. So I'm really combining these ingredients into, this is my big setup. That's how I set up futures. Now you can't do quite the same for stocks because we don't have a commitment to trader report. But what I do is have a synthetic COT report that we can apply to stocks. So here's how the trade looks. This is July soybeans. We knew my yearly forecast written last December said this market should start a substantial up move and wait until May 3rd. And May 3rd was this day right here. So at this point in time, we're above the volatility entry, aren't we? And look at the accumulation that's come in this market. My gosh, at this point in time, price is still back here. Look at the huge amount of accumulation where price is equal here. This red line, price is the same here as it was here. Look at accumulation in the marketplace. So a whole lot of professional accumulation come in the market, and we're in an uptrend. We have trend line breakouts, you have moving average breakouts, you have patterns, you have all that type of stuff that took place, and then you can see what happened in the market. And you just trail your stop up, you're out, want to get back in again, oh, still accumulation in the market, you have another volatility entry in the marketplace. So it's confirm and enter. Well, it's probably time to see if you have questions. Why don't you see if you have any questions. If you do want to listen to my weekly comments, Larry TV, you can go to our website, ireadytrade.com, learn more. There's a lot of free lessons. There's a lot of stuff that you might enjoy getting on our mailing list. And we have some really good, I think about 20 trading lessons in there that I think, well, the response has been pretty good. It's just my distillation of, my thinking and my ideas about the markets over these years. Steve Cohen going to get slammed? I hope not. Steve Cohen's the best trader I've ever met in my life. I've never seen anybody as remarkable as the trading as Steve is. Absolutely sensational trader. He does not deserve what's going on with him. Any chance of covering a 13-week rate of change next time? Yeah, I guess we could look at that next time. Is the second edition of your book the latest edition? Yes, the second edition is the latest edition. I don't even know that I'll do another book. I never learned to type very well, so I hunt and peck. And as I'm getting older, I have a little bit of arthritis in my fingers, and it just hurts. So I even do my dictation now with Word Dragon when I can. So I probably no more books. So any other questions, or we kind of wrapped it up here? Does Michelle still trade? No, my daughter won the Robbins World Cup Trading Championship in 1987, 86, 89, I forget when the year was. Took $10,000 to $110,000 in a year. And as some of you know, she's become a pretty famous actress, 3 Academy Award nominations. I saw the other night she's now advertising for Louis Vuitton, their new advertising piece, whatever. She makes a huge amount of money doing what she does, and it's a whole lot easier to be an actor or an actress than it is to be a trader. You go on movie sets and they have your lunch for you and your breakfast. You get picked up in a limousine. I mean, that is a life. It's like, why didn't I learn to become an actor? Oh my gosh. This is what we do is hard work, guys. There's a lot of risk in it. A couple other questions have come in here, and I have to move this back a bit. Oh, thank you for that comment, Josh. When will you do? I wish I knew this before I started trading again. Well, just hang out and we try to review the stuff we have on Tradestation. What do you think about Bill Williams? I've known Bill and Elaine for a long time. I don't really know his strategy. Bill and I have just been friends for a long time. He's certainly a survivor, but I don't actually know his strategy, so it's really hard to comment on it. Yes, it's recorded. Larry, in terms of defining short-term highs, you said it means that the bar before and after have lower highs. Is that correct? Yes. Well, so yeah, new ideas are great, huh? Is your cycle indicator in Tradestation? Yes, it's in Tradestation. Right now, it's a tool that you pay for. And we're going to lower the price on that. We're going to put these packages together, so there's just a couple of them. So if I try to wait, buy the free ones. You don't have to pay for them. Get the free ones, right? And then when we're ready with the special new prices that we're having and stuff, then you'll find out about it. If you want the cycle indicator right now, hey, great, go buy it. You get it every month, whatever. But probably within 15 days, we're going to substantially lower the prices on all this stuff. And I think if I were you, if you can wait, I'd wait, save yourself some money. Okay, that's about it. I guess it's wrap up time. I would like to thank Mike Burke at Tradestation, who's been so incredibly supportive of me being on Tradestation, and I've really enjoyed this opportunity. It's always great. So many of you I've known. I see the names, and I've known some of these people for a long time. Some of you I'm the second and third generation of families with. That's always cool. And above all, I know Mike would join me in just thanking you for being here. And without you guys, we wouldn't be here. So you're a heck of a lot more important than we are. And thank you for taking the time to look at my work today. I hope it helped you. I hope it gave you a little bit of knowledge that you didn't have before, a little sense of direction. So thanks everybody very much. And in closing, I'd like to wish you good luck and good trading.
Thank you very much, Larry. That was great. Thank you, everybody, for attending. As I said, Larry has another event coming up August 22nd, which is the third installment of this, and he has his Strategy Network Showcase the week after that. So here's the link to register for those. Again, thank you, everybody, for attending, and we'll see you at another TradeStation event. Have a good evening.